The U.S. has dominated the oil and gas sector in the last decade at least, but how long could this dominance last given lower oil prices today? And what would a waning American oil dominance mean for oil markets globally in the future? Moreover, in the longer term, could the U.S. continue to dominate the energy sector as the transition to clean energy quickens again? Or will the Chinese competition prove too much for America in the future? Joining me to discuss this and more is Robert Clark, the Vice President of Upstream Research at Wood Mackenzie, joining me from Texas. Robert, thank you for joining me on the show. What are the main factors that have underscored U.S. unconventional oil and gas outperformance in the last 2 decades? Let's start from there.
Yeah, absolutely. Well, thanks so much for having me, and thanks so much for having Wood Mac. And we appreciate you reading the big piece of research that we published on this a few weeks ago. So U.S. unconventionals have been transformational for global hydrocarbon supply. There are lots of reasons that I'm sure lots of your listeners are aware of: the commercialization of shale, of course, the competitive nature of U.S. upstream and thousands of companies working to get better each year. But in the particular paper that we published on U.S. energy dominance, we highlighted 4 things that separate U.S. upstream from global upstream. And I'll just work through those 4 super quickly. The first one is continued cost of supply reductions. So in simplest sense, in real terms, $1 put into upstream, into new wells, what is the resource extracted for that dollar spent? That has continually moved lower for well over a decade. The second point is a lot of liquidity in M&A markets. So the constant churn of assets from one company to another has really set the stage and incentivized companies to simply get better and make assets better than the company prior to them. The third point is low fiscal take. So part of the paper, we highlighted what remaining value percentage of upstream projects goes back to the operator or is retained by the operator. That number is exceptionally high in the U.S. And that allows for kind of leading aggressive reinvestment rates back into the assets for continued growth. And the fourth point that we highlighted in the note was flexible CapEx. So I'm sure a lot of folks listening to the show will be familiar with short cycle barrels. What that has allowed the U.S. to do is in periods of price strength, really the sector has really leaned into reinvestment in CapEx. So there are certain years in sort of a strong price environment where U.S. CapEx relative to global conventional CapEx accelerated 20 times faster into that price strength. So those are the 4 points that we really tried to highlight in the paper.
So, Robert, these are the 4 strengths of unconventional American upstream sector. So what are the challenges today that you think will face continued U.S. upstream dominance moving forward?
Yeah, so we titled the paper as well, Tough at the Top. So you're absolutely right to ask about some challenges. I'll just offer 2 kind of fundamental ones in this conversation. And the first is simply, the big productive shale basins are maturing. Every basin has a creaming curve. Every basin finds it a little bit harder to keep growing as it ages. And the U.S. has drilled hundreds of thousands of horizontal wells, and typically operators drill the best ones first. You combine that with some pressure depletion in reservoirs, and again, just simply put, the basins are maturing, so it's going to be tough geologically, I think, to keep growing at the same rate. Right? The second point is a little bit more oriented to public markets and corporate behavior. And the U.S. Upstream sector has morphed over the past 5 or so years to having different types of relationships with their investors. and maybe said another way, is there's a strong focus on high cash returns and large and growing dividend policies. So in periods going forward where prices might be a little softer, that fixed dividend commitment is going to limit how much capex can be put back into the system to drill additional wells. So you have basins maturing, and you have a little bit of a ceiling on reinvestment rates, back into those physical assets in the field.
So you currently project a plateau in U.S. output levels to begin and set in the early 2030s. What are the major implications you envisage could impact the U.S. oil sector as a result of that?
Yes, that's a really good question, right? And I think one of the overarching things to be aware of is just a sort of perception change, right? I think it's right, and we offer this in the paper, to discuss U.S. oil and gas dominance, given what has unfolded the past 2 decades, right? But the narrative will change as it's clear that the U.S., first in oil and then later in the future in gas, does start that plateau. So point one is just a little bit of perception, right? How that trickles down, I think, into company behavior would be around multiples and valuations in the market, right? So by definition, if the U.S. has plateaued, not every company can be growing. And for companies that aren't growing, if they're valued or viewed as needing a lower multiple in the market, that might offer them a little bit less flexibility to evolve their business. Right? The second point could be when you think about U.S. oil and gas exports now, how that has grown, how that is something that the administration would like to grow more. If you're a buyer on the other side of that deal, that supply deal, and the U.S. has continued to grow for decades, that gives you comfort, right? But when the U.S. starts to plateau, we just raised the point in the paper, will that be a little bit harder for the U.S. to continue to have those strong export relationships, as the macro data show U.S. production starting to plateau?
Robert, there's been plenty of, let's say, doomsayers in the past suggesting U.S. shale oil production has peaked, but innovation has always been a competitive edge for shale producers. Do you think this time around could certain technological breakthroughs extend or further extend the Permian's production profile, and what would or could those technologies be?
It's a perfect question. It really is a perfect question. Shale has proven to be really, really resilient, right? And it's a topic that a lot of time is spent within Wood Mac trying to fully analyze and then forecast going forward. What I can say is where a lot of technology focus the past decade has been on kind of drilling larger wells, right? I think the focus is starting to shift now to being a lot more capitally efficient with those wells and removing non-productive capex. So maybe a little bit more detail on that, if I could just push on it. There's a lot of money spent on downhole completions in horizontal wells that isn't perfectly effective, right? So we're pumping a lot of stages, and maybe we're not getting as much hydrocarbon back from those particular stages. The focus now is shifting to spending the right amount of downhole capital, maybe not to recover more resource, but recover it at a lower unit cost, right? So I think that's the technology win to look for going forward, is probably a little bit more on the cost side, than on the productivity side. And I think that probably links back to what we were talking about a couple minutes ago about this sort of plateau in output, right?
Well, do you think, given what you've just presented to us, Robert, is there still a place for exploration in the shale plays in the United States, given that the basins have been worked extensively in the past 2 decades?
Yeah, I think there is, but it might be a little bit different than exploration of prior cycles. And if you just maybe visualize a map view of the U.S., a lot of exploration historically was sort of done north to south, east to west, laterally, looking for new basins, new geographies where commercial shale projects could exist. Going forward, with a little bit less risk tolerance in the system, I think some of that exploration will occur vertically, right? So one of the things that differentiates the Permian, and a lot of E&Ps will talk about this, is the stratigraphy and the number of potentially productive reservoirs and zones, right? So let's just use simple round numbers. Let's say that, 5 primary zones in the Permian contribute most of production today. We could see, and we probably will see, more exploration dollars being put on 2, 3, 4 additional zones to try and find additional commercial resource, but exploring vertically rather than laterally across a map.
All right, if we want to extend our outlook, and once U.S. production of oil and gas begins to decline, starting in the early 2030s, towards the end of the 2030s, will it be able to translate its past dominance in oil and gas into low carbon energy, into clean tech? Or would the gap with China's dominance in clean tech and its supply chains be just too large to close for the United States then?
Yeah, it's a good question. Thank you again for reading the paper ahead of this conversation. It is one of the points that we make, and a slight parallel that we draw, where the U.S. is currently dominant in oil and gas today. There's a similar level of dominance in renewables, and that renewable dominance is within China. An important part of that commentary and the graphs in the paper that get into that is that the U.S. is number 2 on that chart, right? It's lagging by quite a lot, but it's not sort of out of the game today, right? To answer the question directly, I don't think there's much that could happen in the short term for the U.S. to try and be dominant in renewables. Longer term is different, though. Right? If we maybe think of some parallels which helped unconventional oil and gas perform well and grow quickly, there was a lot of private capital in the system, right? And there was government support in the terms of early tax credits, right? So we'll need to see what happens over the next decade or so within the U.S. in terms of work coming out of national labs, how much private capital continues to go into renewables, are there inflection points in those charts and graphs, how does that change? But short term, going to be really hard for the U.S. to go number 1 in renewables. Longer term, let's see.
Well, my guess is that this will need policy support, which looks like it's on shaky ground at the moment. But moving to the shorter term and staying there is more evidence, Robert, of slowing shale oil activity lately. Several shale oil companies have cut projected output for this year in response to the current price environment. Diamondback, a prominent shale oil company, for those who don't know it, has even predicted that the Permian production has peaked. So how plausible is a scenario where we see this peak earlier than you anticipate? And can we correctly say that the U.S. shale oil has entered its twilight years?
Yeah, so lots of headlines, lots of great quotes floating around the space in relation to that. You're absolutely right. I think splitting hairs and really getting into the details is actually quite important with this. Right? So projecting a peak now or in 3 years or in 5 years, that's important to sort of nail that down, right, for the points we discussed a few minutes ago. It's also important, I think, to be a little bit clear on, are we talking about total U.S. production? Are we talking about total lower 48 production? Are we talking about just the Permian, right? The way we model it and see it now is, lower prices in 2025 and 2026 has brought our peak lower 48 number closer. It has, right? But that's a total lower 48 number. Within that construct, the Permian is really unique in terms of the size of the resource, the big companies that own the resource now, and their desire and strategy to invest through the cycle, where the Permian sits on the cost curve, right? So we still see the Permian growing, right? Total lower 48 production, though, we think will start to trend down a little bit next year. But again, it's a function of price, right? So we're having this conversation sort of a little bit oriented around lower prices. If hypothetically this conversation was oriented around an extra $15 on the oil price, not off of the oil price, we would not be talking about near-term peak U.S. production. We will be talking about how high and how far into the future. So still very price dependent, but a great topic to bring up.
Yeah. Well, Robert, this is my final question. And what do you think would be the implications of a peak in U.S. shale oil on the wider global oil markets? What would the loss of this short cycle sort of swing producer be?
Right. So I might politely challenge you just a little bit on your use of the word loss. I think maybe we could recharacterize it as loss of big growth. Right? So a U.S. peak doesn't mean that there's going to be rapid declines the next month and the next year, and we're losing, 2-3 million barrels a day of production. We project a pretty lengthy plateau, right? What that offers the global oil market, though, is the opportunity for other geographies to sort of carry that growth baton. And just staying in the Americas, right? Latin America, is set to provide quite a lot of extra production to the market over the next 5 or so years versus today, right? So longer cycle projects in Brazil are still growing. Guyana, of course, is set up for a lot of growth. Argentina is set up for growth. Some of that is tight oil as well. So a little bit of a plateau by the U.S. offers the opportunity for other geographies to step in. And within the Americas, again, just to reiterate this important point, that's exactly what's happening with Latin America.
Robert, that's our time for today. Thank you so much for joining me. Robert Clark, the Vice President of Upstream Research at Wood Mackenzie. It's a pleasure to have you on the show. Thank you.
Absolutely. Everyone have a great day, and we'll see you soon.
Thank you, Robert.